I am Ben Carlson. You are watching Ask the Compound. Let's say you plan on retiring at age 55. Should you pay off your mortgage before you retire? We'll cover that and more on today's show. Stick around. Welcome back. Ask the Compound. Our email here, askthecompoundshow at gmail.com. The emails always just keep coming in. Pouring in. We have reams and reams of questions. Google Doc is full. On today's show, timing market corrections with your cash from your high yield savings account. Should you do it? A lot of people wanted more meat in the bone of the buy the dip stuff. How your portfolio should look heading into retirement. How you should think about your mortgage heading into early retirement. A financial advisor wants to know if it makes sense to manage money for his parents. I wouldn't do it. Spoiler alert. And a middle-class couple came into a big inheritance, but one of them is having a hard time spending money. Today's show, sponsored by Rocket Money. I was talking to my brother last week, and he mentioned how he's completely lost control of his subscriptions. There's too many streamers and gym memberships and all these websites, and I can't figure it out. Too many, I don't know what the cost is. I can't keep track of the prices. He told me there should be a service that tracks this for you. And I said, you're in luck. I use Rocket Money. Rocket Money is a personal finance app that helps find and cancel your unwanted subscriptions, monitors your spending, and helps lower your bills so you can grow your savings. 5 million users have saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all of the app's premium features. I looked at mine today. It's like streamer, car payment, streamer, financial
so much
website,
easier than
financial
cable,
website.
you know?
Yeah, it keeps it, makes it easy. Cancel all its unwanted subscriptions and reach your financial goals faster at Rocket Money. Go to rocketmoney.com/ATC today. That's rocketmoney.com/ATC. Easy app, easy desktop. It's very nice. Let's do it. What do we got, Duncan?
Okay, up first, we got a question from Josh. I recently read your article on whether buying the dip works. My wife and I are still relatively early in our careers, mid-30s, and are both relatively high earners. To avoid holding too much cash, we invest excess cash weekly. Our cash sits in a high-yield savings account, currently earning 4%. Would it make sense to invest some or all of that cash when there are market dips? Since our strategy wouldn't involve selling to support buying, does that change your advice?
Okay.
It's crazy seeing these yields on high-yield savings accounts. I remember when it was like 0.25% not that long ago.
Right. 4 or 5%. It's pretty nice. I think that makes the temptation to sit in cash even greater. But we had this question a few weeks ago about buy the dip as a strategy. And this person wanted to know, let's say I take 10 or 20% of my stocks, I put it into fixed income or cash, and then I wait for a correction. Is that a good strategy? And I said, well, the strategy could work, but the behavior that you're introducing, I think, is the problem. I think you're better off picking an asset allocation or strategy and sticking with it. Daniel Duchardon, I created this after the fact, looking at the months between 10% pullbacks in the S&P. You can see there's been some times where it's been a very long time, and you can see this is the number of periods in blue that are greater than a year. And it could be a long time. That one at the end there, we're talking, 7 years or something in between a pullback of 10% is the longest. So you could be waiting a very long time. Now, this question, chart off, Daniel, gets to something else. Josh and his wife want to put their cash in their high yield savings account on a regular basis. And they just want to know, like, hey, if a correction happens, can we tap that cash and put it into the market? And I'm a big proponent of having rules in place to guide your actions, but I do think some investors get hung up on like language and appearances. And I think they're worried, like, well, am I timing the market here if I do this? And I'm not a huge fan of timing the market, but all investment decisions have some component of timing to them, right? When you buy and sell, when you rebalance, when you make your contributions, and there's some luck involved, and sometimes there's skill, I guess, but most of the time there's luck. And I guess the way that I approach this when it comes to investing cash, for liquid purposes, we keep our cash in a high yield savings account as well. I think it's just easier. It's very easy to transfer money in and out. You don't have to worry about buying and selling. Could I squeeze a little more yield out of something else, T-bills or something? Sure. But I think it's just the ease of access with a high yield savings account is simplifying for me, right? Now, we like to have different buckets within the high yield savings account and give them all a job, right? This bucket is for vacations. This bucket is for home renovations. This one is for estimated tax payments. This one is for property taxes. This one is for car repairs. Duncan's got a bucket for hats. All these things, right? But then there's like this amorphous emergency fund over here. That's just like a bucket that doesn't really have a job. It's just kind of a backup, right? Kids need braces, that sort of thing. whatever. And I have a threshold for that emergency fund. And when it goes over a certain threshold, if I've been saving for a while and we didn't have the emergency out of nowhere and the money keeps piling up, then I'll take it and I'll sweep that cash and I'll invest it, right? And I don't look at that as market timing. And I could say, you know what, I'm going to only sweep it away into my brokerage account when there's a correction. But I guess I just don't want to think that much about it. And so I've done that many times over the years where I've had excess cash and I'll just put it into the brokerage account and I'll just buy. I won't think about the timing or the valuations or the interest rates or whatever it is. I put the money in when it's there, and I don't fret about it. I don't try to time the market. I just invest it. And I'm sure if you look back at my strategy, I'd probably be worse off if I waited for a correction as opposed to just investing it when it was in there and not worrying about the timing of it. So I think you're better off just putting it to work on a regular basis, picking an amount that you want in that high yield savings account, and anything over and above, I'm going to invest it. If you want to use the dips to, increase that amount, sure. But I think just regularly invest it. That's going to be, it's so much less brain damage. It's so much easier. Just do it. And if you want to write some simple, rules in place, Dave Avery in the chat says, put some rules on when to sell and when to rebalance and that and following it. That's fine. But I think you're probably better off just every time it hits a threshold, invest the money. Don't worry about the timing and what the market looks like.
Are you okay with someone saying the Nasdaq's up 2% today? I'm gonna, hold off. I don't want to put in today. I'll wait a day or two and
no,
no,
not
okay.
No, what is in the grand scheme of things? What is 2%?
Well,
what is that going to get you?
Most days the market's not up 2%, right? So I'm just saying, to me, it just always feels a little better if I'm like, you know what? Maybe tomorrow it'll be down 20 basis points
are there
or something.
times
I'll put it in then.
When my 401k hits, does it feel a little better when the market's down? Sure, but I just think in the grand scheme of things, if you're investing in the stock market...
Wait, you don't time your 401k contributions?
Yeah, weird, huh? I think trying to get too cute with these things, it just never works. It might work a couple times. It never works over the long run. I think I don't know. In 30 years, you're going to go, oh man, that 2% update really killed me. It's not going to matter. It's all noise.
Yeah, I guess
Bill Sweet in the chat says he times his 401k contributions. He probably puts them all in January for tax purposes.
That'd be funny.
Let's do another one. I just think, I understand. The good news is if you're to the point where you're splitting hairs like this and you're making these kind of decisions, you've probably already made all the big decisions
You're
anyway.
on top of things.
Yeah, you're probably on top of things. And if you get down to this, but I think when you get down to these nitty-gritty little things, I just always opt for simplicity and not overthinking it.
One thing I was going to ask, though, is technically treasuries are local and state tax advantaged, right? So if you're putting your safe money away, there is an argument to be made for doing that as opposed to a high yield savings account, right? Because that is not tax advantaged in any way, right?
Sure. And again, for me, it's more about the liquidity and the ease of access and the ease of use for that to getting in and out of that money. So yeah, if you're worrying about taxes there, that could be a thing. It is funny. There are people I've heard in recent years be like, I don't like how I have so much more money from yield because now I have to pay higher taxes. It's like, okay, you could just not earn the income.
I'll take it.
Pay the taxes.
I'll take the money.
Yes.
Yeah.
All right. Let's do another one.
Up next, we have a question from Jeff. I'm planning to retire within a year. Since I'm so close, I've been checking my accounts almost daily and probably watching more online political content than I should. Every headline seems to warn of cuts, crashes, and chaos. I'm almost 64 and nearing my magic number. I've recently made some moves and adjusted my asset allocation into what's appropriate for me heading into retirement. I sold stocks and put the proceeds into a money market fund. My question is, where should I invest this money to keep pace with inflation, while also protecting myself in case of a major correction or crash? This money management stuff sure gets harder the older I get.
It's kind of funny. When we were growing up, the baby boomer parents of ours were telling us, don't play video games, don't watch scary movies, don't listen to rap music. And the worst thing of all is watching cable news, probably. And they're the ones who do it the most.
Yeah, for sure.
So this one sounds like an investing question, but I think it's really a behavioral question. So let's bring on one of our favorite behavioral experts, Mr. Barry Ritholtz.
Hey, Barry.
Hey, guys. How's it going?
Good.
So, Barry, the headlines are getting to this guy, getting to Jeff. I don't know. Maybe it's like George Soros when he has the store back and he decides to lighten up on the risk, that he just decided, I'm seeing all this stuff in the news, I'm lightening up. Whatever it is, he's almost retiring. He's got to his magic number, but he's paying way too much attention to the headlines and to the news, and he's worrying about chaos or whatever's going on, and he's using that to guide his actions. and again, maybe he's using this as a jumping off point because he's about to retire and he knows he needs to de-risk a little bit. But I'm just curious what you think about this idea of watching the news and then making a decision, and how messed up that can make your investment process.
Yeah, this is kind of a fascinating question because it's really two separate questions in one. One is the actual blocking and tackling investing for retirement question, and then there's the behavioral side. So let's address both of them. So if you're almost 64, a couple of questions you have to ask. What's your life expectancy? And I know that's a very general question, but a good way to get to that answer is, hey, you had 4 grandparents. How old did they live till? If, like, your grandparents all died in your 70s, all right, well, then hopefully medical technology has improved and you have a longer runway. But I'm always fascinated when people say, well, both grandmothers lived deep into their 90s, both grandfathers lived deep until their 80s. Hey, at 64, you got 30 years to go. You really have to have a robust equity exposure.
You know, Social Security has a calculator for this. You put in your age and birth date, and they tell you how long you're expected to live.
Right. So
sounds fun.
So, if you use a target date fund in your 401k, this will adjust it automatically. But if you want to have a hand on the tiller, well, maybe you're 70-30 through your 50s and 60s, and then you're 60-40 in your 70s. And by the time you're, 75-80, it's really a question about your comfort level with risk. The behavioral side is also revealed. How do I protect myself in case of a major correction or crash? You want, the upside is a function of putting up with the downside. You get paid to live through the drawdowns. And it's only when you're in retirement that corrections and crashes are problematic. So one question is, hey, are you really concerned about a crash? Is that the problem? Or is your news flow and information hygiene so filled with, so lacking and filled with noise? I don't care if you're on the left or the right. MSNBC and Fox News are not good for your portfolios. No. They have become experts in manipulating your emotions, just as Twitter, Facebook, TikTok, and Insta. The algorithm knows exactly how to suck you in, get you involved, and generate outrage. And that's also not good for your portfolio.
So you brought up a great point that, like, the crashes and the corrections really matter when you're in or approaching retirement. And I think that's when asset allocation matters the most. When you are reaching that threshold, you don't have the income and the wages or the time horizon to allow you to see them through as much anymore. So you need to have more balance. That's the whole point. And I think maybe that's what even if he got there going under the wrong pretense here because of the news, that's where he took a quarter of his portfolio and said, I put it into cash, now what do I do with it? Maybe the answer is you keep it in cash and you're fine there because that makes you feel
certainly
safe.
Money market, to say the least.
Money market, cash, T-bills. Maybe it's taking a little more risk and taking bonds or treasuries or corporate bonds or whatever it is, something in fixed income. But at least that you figured out that I need to have more balance because if the stock market does crash, whatever the reason is, whether it's the stuff that's going on in the news or something completely out of left field we don't know about, then you have this piece to see you through. You just have to figure out, like, how many years worth of safe assets do I need that's going to keep me safe? That's one of the questions that we got, I think, a month ago or so. If someone said, how many years do you need? Well, you can't answer that perfectly without understanding, like, what's your tolerance and appetite for risk. But I think that's a good way to look at this is how many years worth of cash and spending am I comfortable with that will see me through the inevitable downturns?
And for the people who are data wonks, the technical area that we're discussing is sequence of returns. If you retire into a downturn and you immediately start drawing on that cash, you're much worse off than if the downturn happens a few years later. And sometimes it's just dumb luck. You could do everything right, take a minor setback because, hey, anyone who retired December 31st, 2021, that was not a fun way to begin your retirement. It's not just the cash and the double-digit down year for stocks and bonds. It's the stress on top of you're starting with the next 10, 20, 30 years with a portfolio that's, 20% smaller. So it's a little random. Our friend Bill Bernstein has done a lot of work on this.
Yes, I got an email from a guy a number of years ago saying him and his wife retired in the spring of 2000, which was the peak of the dot-com bubble, right? Yep. Then you had a 50% crash then, and stocks came back, and then you had another 50% crash in the Great Financial Crisis. And he laid out his plan that he did to make it through then, but he was saying to me, like, it was awful. It was, I couldn't have timed it any worse, and luckily we did okay, and we held for the long run, but he said the thing that kept us through was having a few years worth of cash in T-bills or some sort of short-term fixed income that could see us through, and that was the thing that helped them survive those two crashes.
Yeah, huge. It's huge up. The ironic part is, and we'll talk about this some other time, but the crashes early in my career where I had no money in a 401k, I didn't have much of a portfolio, my wife's 403b was tiny, they felt like they were world-ending. Right. And then fast forward 20, 25, 30 years later, crashes where there's a lot of money at risk, you kind of shrug off because it's like, yeah, I've seen this. I know how the movie ends. Every time we have a crash, a bear market, eventually things recover. And you just kind of, the ones that mattered the most affected me the least. The ones that mattered the least to my portfolio affected me the most.
Yeah, that's a hope that you get used to it, right?
This too shall pass is the philosophy you eventually embrace after you see enough cycles. You just know.
I'm a Vonnegut guy. I just say so it goes.
So it goes. That's right.
All right, another question, Duncan.
Yep. Up next, we got one from Nathan. I'm curious to know your thoughts on managing money for your parents. My parents are getting close to retirement and have about $3.3 million with an advisor. I'm a CFP and I ran a financial plan for them. They're in good shape. I'm thinking about co-managing their account with them at a custodian like Schwab or Fidelity. My mom, who used to be a financial advisor herself, has a good understanding of investments, so I don't have to rely on my expertise alone. I'm looking for your advice on whether this would be a good idea, or if you have any other suggestions on how to handle this situation. They're excited for me to take over the management, but I want to make sure I make a smart and well thought out decision.
Okay, so when I joined Ritholtz Wealth almost 10 years ago now, I think 10 years ago this fall, my parents were using another wealth management firm to manage their money, and I wanted to bring them over to Ritholtz Wealth. But I did that, and I completely stayed out of it. They have their own advisor at the firm, not me. I did not want to be their advisor, and I don't think they would have wanted me to be their advisor. I do think there are probably some benefits to Nathan being his parents' advisor, and the fact that his mom was already an advisor. He's got a better sense of what's going on for estate planning issues and all that stuff, and the inheritance. But I don't know. I think bringing anytime family and money like this, it can just open up a whole can of worms that is hard to put back. What do you think, Barry? What do you think the odds of this working out for managing your parents' money like this?
It's fraught with risk. I 100% agree. When I first saw the question, I started making some notes. The first question was, why would you want to do this? You're certainly not doing it for the fees. They're getting the friends and family rate, or you're waiving them entirely. So it's not for that. The big issue, and I have a million horror stories about this, but I'll share one. The big issue is the siblings, the rest of the family, the communication, making sure everyone's on the same page.
That's the thing where it could get tricky, is the siblings. If they say, wait, you're managing mom and dad's money?
And if it goes bad, well, you know what Thanksgiving is going to be terrible for the rest of your lives. But quick story. Harry passes away, 83, 84, something like that. He leaves his wife a decent amount of money. Eventually, the next few years, she lives at home, but eventually she moves into assisted living because she could no longer drive. And so the mom was concerned that the kids put her in a very high-class assisted living, and it was started out at like $8,000 or $9,000 a month, and it goes up to 10 and then 12, and eventually, as you work your way through increased levels of a support, eventually memory care and hospice, it goes up and up. And the mom said, "Oh, this is so ritzy, and so this how can I afford this?" And so the kids lied to mom and said, Harry left you in great shape. You have plenty of cash. This is fine. And that was true for like 5, 6, 7 years. But she lived to her 90s. And the last few years, they were lucky. The oldest son was a lawyer. The daughter, I think, was a doctor. So when the money ran out, they just were subsidizing. Right. The third son, who I want to say was in Arizona or Texas, I don't remember the specifics. The third son, who the two older kids were, local, Connecticut or New Jersey. The third son was out west. So he spoke to mom regularly, but he had no idea what was really going on. And there was no communication. They didn't want to tap him for money. They were doing well. He was only doing okay. And so at the funeral, the story goes, so where's all the millions of dollars mom had? What are you talking about? She ran out of money 5 years ago. We've been subsidizing this forever. That's not what she told us. Here are the books. Here's the paperwork. And it created a rift in the family. Yeah. So long story short, anything involving family and money, make sure everybody's on the same page. Loop in the siblings, the grandkids, anybody's involved.
That's true. Communication is key.
100%.
I'm picturing Nathan's brother being like, if you'd invested all of it in Bitcoin over this time.
Why weren't you in NVIDIA for the past 5 years? It's, everybody is a Monday morning court. Here's what the Kansas City Chiefs should have done. Everybody's a genius the day after. Hindsight bias is rife. This is just so fraught with danger. I see no upside and nothing but downside. I'm with you, Ben. It's just too risky.
I would just tread lightly. Seth in the chat asked, "Wait, financial advisors have financial advisors?"
And I was going to ask you that. I had actually made a note.
Yes, it's and I think
how common is that?
I think it's
fairly
very common.
Okay.
Yeah, I think for people in our industry that we talk to, it's fairly. I've heard Carl Richards talk a lot about this. He's kind of a financial advisor for financial advisors, and he has one. And I think it's helpful because you see how important it is to take yourself out of the equation and let someone else make decisions for you without getting so emotional. Because no one's more emotional about your money than you.
Right. Typically, though, is it someone internal, like at their same firm, or they will literally have a financial advisor at another company?
I would imagine typically it's internally. Bill Sweet is my financial advisor.
Okay.
Right?
Yeah, you just have no objectivity for your own money, your own family. You bring someone in, they see it from a different perspective. In a way that, you can't. The really crazy thing is with the story I told, that's absolutely true. And I want to say I don't remember the exact numbers, but we looked at them. It was $6 or $7 grand a month to start, and she ran through. How long does it take to run through? $3 million, $7,000 a month. Plus, there's some travel. Plus, she's buying the grandkids presents, every Christmas and birthdays. And so she's going through money, and you would think it would last a while, but at a certain point, it just runs out.
All right, another question.
Okay, up next we have a question from Raj. I'm 46 and plan to retire by 55. I've calculated that I'll reach my retirement number in another 6 years, giving me a decent buffer for retirement. I have a $500,000 mortgage at 5.625% with 28 years left. I'm comfortable with debt and don't see a big concern. I agree with your thoughts on liquidity and inflation reducing the debt load. My only concern is retiring with the mortgage. We plan to move after retirement and not stay in this house. I've run calculations and there's no significant difference either way. Discretionary spending is slightly reduced until retirement in the payoff scenario, but increases by $50,000 over a lifetime. It seems like it's ultimately my decision. I'd appreciate any suggestions on how to approach this situation.
It's funny. 55 is always the number for early retirement. Kind of like 40% is the number economists use for every prediction they have. When someone says, I'm going to retire early, it's always 55. No one ever says 53 or 57 or 59. It's always 55. I don't know if just we love big round numbers, but all the questions we get, it's always 55. I have been strongly opposed to paying off a mortgage, especially at a young age, or especially if you have a 3% mortgage. I think that equation changes a little bit with rates at 7%. However, I do think the calculus changes also when you were retiring early. I think, so he's 9 years from retirement. He ran the numbers, and it's essentially a wash, so it's kind of up to him. I like the idea of paying down your mortgage before retirement. But he had one other piece here that I thought was interesting. He said, well, when we retire, we're not going to stay in the house. So I assume that means he's going to sell. Downsize, travel the country in an RV, move to another country, whatever it is. So if you're planning on selling the house when you retire anyway, what's the point of paying it down early? I don't see what the point of tying your money up in the house so you can get a bigger equity payout when you sell. Because what if, I don't know what the housing market's going to be like in 9 years. What if you can't sell on time and that money's stuck there? So I guess I like the idea of paying off your mortgage before retirement to give yourself some peace of mind and some margin of safety. I don't know if you're going to sell it anyway. I don't know what the reason for paying it off early is.
Especially if you're at 5 5/8 and the mortgage market is at, a 1.5% higher. Right now, it's 7.25%. So there's no reason.
See, this is a New York thing. You guys always use fractions for your rates.
Right.
Michael does the same thing.
I started on a trading desk with quarters, eighths, teenies. So 5.625 is much lower than 7.125 or 7.25. So the math answer is, as long as you're at an advantageous rate, there's no and you have your the cash that would otherwise be tied up in the house is invested in, earning a reasonable amount. It's a wash. If this money is in a money market account, it's a wash. But Raj says he's comfortable with the debt, so he kind of answers his own question. But there's a real important thing that I want to emphasize, and you kind of hinted at it earlier. Ben, you've been with us over the past 10 years. How much has everything changed over 10 years? How much has your life changed? How much has the world changed? How much has the market and the economy changed? We think we know what we're going to want in 10 years, but damn, 10 years is a shockingly long time. So what I would advise Raj to do is don't just hyper-focus and lock yourself into, I'm retiring at 55, come hell or high water. You should revisit it each year and say, hey, maybe I don't just want to fish or play golf. Maybe I'm still productive. Like, I get this question all the time. Hey, when are you going to retire? I don't know. As soon as the hospital unplugs me, that's when I'm retired. I'm not a golfer. I don't know what I would do with myself. I'm always shocked at people who want to retire at 40, 45, 50. You have to have a purpose in life. And I'm not saying our only purpose is work, but I would really rethink what your expectations are, or at least carefully consider, why do you want to retire at 55? And is that the best course for you?
I think you could stay pretty busy rebuilding classic cars. I don't know.
At this point, I'm more inclined to pay people to do the dirty work than, I used to be pretty good with a wrench. Nowadays, between the electronics and everything else, it's much harder.
Well, speaking of cars, we got one about a car in the last question.
That's a segue, Ben.
That's a pro move right there.
All right, up next, last but not least, we have a question from Sam. My wife and I are worth many millions of dollars. Serious not to brag, though, since it all came from my grandparents in recent years. I like the honesty there,
Yep.
We still have a middle-class mindset and plan on leaving most of the money to our kids and giving the rest away to charity. However, I've always had a desire to drive a luxury vehicle. My wife thinks it's a waste of money. How do I convince her that we're wealthy enough to splurge a little? First world problems, I know, but this is a real point of contention in our marriage.
Well, first of all, good on Sam for giving it away. I feel like this is one of the topics that probably doesn't get spent enough time in personal finance. So many of the people listening to our show and writing in are doing way better than the vast majority of the population with their money. And so I think charitable giving should be a part of any long-term financial plan. And I think my way of thinking about this is, so they got the grandparents' inheritance or however the money came in. I don't know, you're thinking about your kids, you're thinking about other people for charitable giving. Don't you think your grandparents would have wanted you to enjoy some of this money? That's kind of my way of looking at it. And I get the whole, for some people, just the way you were brought up and the way you were raised, it's very hard to change that mindset. And your wife thinks, like, what's the point? It's A to B. There's A to B car people, right? Barry's not one of them. Barry likes driving cars. Whatever the splurge is, it doesn't have to be a car, it could be something else. Barry, how do you think you get people to get out of that mindset and actually enjoy the money a little bit?
I love this question because it's fraught with so many interesting wrinkles. So wrinkle number one is, and I always ask this to people who take pride in driving old cars, 20-year-old cars, don't you want the latest, greatest safety features protecting your loved ones, your family, yourself. I've always, when I had Lee Cooperman on the podcast, he was bragging about driving a 25-year-old Volkswagen. And
See, there's a guy with that old school mindset, right?
Right. And I said, why don't you go get yourself a new car? He's like, I'd rather give the money to charity. And he's, by the way, he's mid-70s. He's still working. He's still putting up really good numbers. And I said, Lee, wouldn't you be better off if you're in a fender bender, not having to retire and give up your alpha generation? We had a deer leap in front of us on the road, and the car, before I could react, the car slams on the brakes. The collision avoidance system stopped the car. I consider myself a pretty good driver. I've been to Lime Rock. I've been to Segway. I've taken every course. It just happened too fast. You humans can't react as fast as a car could. So that's number one. Number two, the compromise. I'm married 32, going to be 33 years this year. So the compromise is if I'm going to spend money foolishly, she has to be on board. So there are two ways to get the spouse on board. Hey, if I'm getting this, what foolish indulgence would you like?
Yep.
So if I'm going to buy this new antique or this old antique car or watch or something stupid that has no material value other than it's fun, hey, what would you really like? Sometimes it's a bauble. Sometimes it's, hey, I want to take my sister, who's not making as much money as we are, to the Caribbean on vacation. Okay, let's go. We'll do that. So there's always a compromise, and then
right. Give yourself. It's the bucketing thing. Like, give yourself a category where you say, I'm going to spend on this category. I'll cut back everywhere else, but this is my one category I'm willing to spend on. And both of you have your category.
Right. By the way, I love Nick Majouli's approach to this now he's engaged, but back when he was a single guy, whenever he would do what he called foolish indulgence spend, he would put a matching amount in his retirement account. So, hey, whatever he buys costs him twice as much because he's saving for retirement. So the other compromise is modern cars, and what I mean by modern is 2000 and forward, like the past 25 years. They're very reliable. They're pretty well built. Yeah, a car from 2006 isn't going to have the latest, greatest safety features or Bluetooth.
You're giving the guy the perfect speech here about safety when he really just wants to drive a nice car.
So that's the compromise. You could buy like a 2010 Mercedes-Benz or, a 2012 BMW, and it's 90% of the luxury of a modern car, of a brand new car. But, 3-year-old cars off lease tend to be about 40% less than new. So you don't even have to go back 20 years. Look for a car that one of my car buddies just sent me, a Ferrari Roma, which new is fully tricked out, was about 3 1/4, 3 years old, off lease, 180,000. Now these are exorbitant numbers, but they're pretty parallel. You could look at Mercedes that were $100,000 brand new and off lease 3 years old. They're going to be $55,000, $60,000. So maybe the compromise is getting something that's not quite brand new, but still scratches the luxury itch, but saves $40,000 on MSRP. That makes the wife happy.
Right.
Well,
Again, first world problems, but
very.
Yeah, we get this in our Slack channel all the time. The advisors will share victories of talking their clients into spending money. We got one last week for one of the clients bought a Porsche and said, "Thank you for helping me figure this out. This is my dream car." Look at it as a victory.
Was this the Cayman or the Boxster? Was it that, or did he go for the 911? Because we had a conversation a few weeks ago.
You know these things more than me.
Oh, all right.
I still don't say
remember
it right.
where
I said Porsche, not Porsche. So
I gave
don't
him
ask
a
me.
list of cars, and I said, "Take a look at these. Here's the new price. Here's the used price. This is right in your." It was a convertible, I think. Here's the list that's right in your sweet spot and what you want to spend. But I didn't find out that he actually pulled the trigger. I'm really glad to hear that. By the way, you would be shocked to see how many people are sitting on, again, first world problems. Millions and millions and millions of dollars they worked for 30, 40 years to save and invest, and they're terrified about spending it. And I don't mean like going out and buying $1 million, gull wing Mercedes that's collectible. I mean spending $50,000 or $75,000 on a weekend toy that they can easily afford.
Well,
Yes.
so on that note, that's a good segue. My strategy I was going to give Sam is, Dan, hit the first photo. So you start sharing photos with your wife of something like a Rimac, and go to the next one, Dan, a Bugatti.
All electric, by the way, 1,000
exactly.
horsepower.
You start sharing some of these $1 million to $5 million cars, and then when you come back and say, let's buy this $150,000 car, looks like a great deal, right?
Classic anchoring. Getting
yep.
her to focus on the high price, and then $100,000 is free. It's practically nothing.
We gave this guy a lot of good tips here. He's going to have a PowerPoint presentation for his wife.
Let us
why
know
you
how
should
it
get in.
goes. Yeah.
Yes.
Hilarious.
I like it. Okay. Barry, new book is getting there. I just finished it recently. When is it coming out?
March 18th. Really excited about it. I'm loving the feedback and the buzz I'm picking it up on. Really excited. When it's out, I'll come back and talk about it.
One of the better looking books that I've seen. The design of it is
Beautiful.
wonderful. The cover, inside, everything, it looks great.
I had a hand in that. I'm really pleased with how it all came out.
Yeah,
If you have a
good
question
job.
for us, askthecompoundshow@gmail.com. Thanks to everyone in the live chat. As always, it's funny. Someone in the live chat said, definitely pay your mortgage off early. Someone said, definitely do not pay it off early. This is what makes a market, right?
It's
Leave us
true.
a comment, subscribe, rate, review, all that good stuff. We'll see you next time.
See you, everyone.